Ladies and gentlemen, good day and welcome to the Jindal Stainless Q2 FY22 results conference call hosted by ICICI Securities. As a reminder, all participant lines will be in the listen-only mode. There will be an opportunity for you to ask questions after the presentation concludes. Should you need assistance during the conference call, please signal for an operator by pressing star then 0 on your touchtone phone. Please note that this conference is being recorded. I now hand the conference over to Mr. Abhijit Mitra of ICICI Securities. Thank you, and over to you, sir.
Yeah, thanks, operator, and good afternoon to all the participants, and thanks for joining in. We are here to discuss Q2 and H1 FY22 results conference call of Jindal Stainless Ltd and Jindal Stainless Hisar Ltd. From the management, we have Mr. Abhyuday Jindal, Managing Director, Mr. Anurag Mantri, Group CFO, Mr. Jagmohan Sood, Full-Time Director, JSHL, Mr. Ramnik Gupta, CFO, JSHL, and the Investor Relations team. Without further ado, I hand it over to Mr. Gautam Chakravarti for his remarks. Over to you, Gautam.
Yeah, thanks, Abhijit, and good afternoon, everyone. We'll begin this call with the brief opening remarks from our MD and the Group CFO. Following which we will have the forum open for an interactive question and answer session. Before we start, I would like to point out that some of the statements made in today's call may be forward-looking in nature, and the disclaimer to this effect has been included in our results presentation that was shared earlier. Now I'd like to invite our MD, Mr. Abhyuday Jindal, to make his opening remarks. Over to you, sir.
Thank you, Gautam. Good afternoon to everyone. On behalf of the management team of Jindal Stainless Ltd and Jindal Stainless Hisar Ltd, I welcome you all to this forum. First, I would like to share the key highlights of Q1 FY22, following which Anurag will take you through the operational and financial highlights. Let me start by giving an overall scenario of the stainless steel market. Global stainless steel production grew by 25% year-on-year to 14.5 million tons during Q2 of the calendar year 2021. Stainless steel demand in most of the regions across the world has been robust. The upward rally in prices of input materials continued unabated throughout the second quarter. The average international prices of nickel and ferrochrome in Q2 of this year climbed by 35% and 75% over last year respectively. This, coupled with strong market sentiment, resulted into higher stainless steel prices as well. As far as our performance is concerned, I am glad to share that we continue to improve our operating and financial performance on the back of our agile product and geographical mix. Continued focus on cost optimization and prudent financial management has also carried. An overall healthy demand environment post the second wave of COVID in Q1 of this year and normalization of demand from all consumer-facing segments pulled up sales volume in Q2 FY22. As general manufacturing picked up pace during the quarter, demand for special high-margin grades like duplex, super austenitic also gained momentum. All major end-use segments like process industry, pipe and tube, railway wagons, metro rail grew during the quarter as stainless steel demand remained firm. Despite prevailing logistical challenges due to container scarcity, we maintained strong operational performance through advanced planning, strategic sourcing of raw materials. Specialty Products Division sales grew by 31% in Q2 FY22 over the corresponding period last year, led by higher sales in blade steel and precision strip segments. On the project side, I am happy to share that we have commissioned 26,000 tons per annum capacity precision strip mill as part of the first phase of the brownfield expansion under SPT. This takes the total precision strip production capacity to 48,000 tons per annum. With regards to other brownfield expansion projects, all are on track and moving on as per our expectation. Now let me highlight some of the issues that are being faced by the domestic stainless steel industry. Imports have been rising substantially during the past few months and surged by 115% during April 21 to September 21, a period over the same period last year. The share of imports in the domestic market in Q2 FY22 was at 40% as compared to 35% in Q1. Despite this situation, the government extended the suspension period of CVD on flat stainless steel imports from China by another 5 months. As the rising import trend hurts medium and long-term prospects of the Indian stainless steel industry, especially the MSME manufacturers, the domestic industry is in constant dialogue with the government on these issues. On the merger front, the company's petition for merger is pending before Honorable NCLT Chandigarh branch for approval, and we expect it to be completed in this fiscal year. During the quarter, CRISIL Rating has upgraded the rating of JSL short-term bank facilities as CRISIL A1+, which is the highest short-term rating, and reaffirmed CRISIL A+ rating on its long-term bank facilities. For JSHL, CRISIL has for the first time rated its long-term bank facilities as CRISIL A+. The reason for these ratings include company's healthy liquidity profile and cash accrual as a result of strong operating performance along with deleveraged balance sheet and a minimal long-term debt obligation over the medium term. With the gradual reopening of the economic activities post-COVID, related restrictions and government push for infrastructural development, we expect India's stainless steel demand to continue to remain robust. As ethical corporate citizens, we have been also taking various initiatives to encourage sustainable operations. I am pleased to share that JSHL has received CII National Award for Excellence in Energy Management 2021 and Global Environment Award by Energy and Environment Foundation. With this, I would like to hand over to Anurag to discuss the operating and financial performances. Thank you.
Thank you, Abhyuday. Good afternoon and warm welcome to everyone joining us on the call today. We have shared our investor presentation with the stock exchanges, and today's call we'll have a discussion on the same lines. The strong momentum continued in Q2 FY22 as well, as far as our operating performance is concerned, on the back of a strong demand recovery and positive sentiment both in domestic as well as export markets, primarily driven by major segments such as process industries, metro, railways, wagon, etc. Let me take you to all of you to the operational and financial highlights of Q2 and H1 FY22. While maintaining major focus on domestic market, our agile business strategy, as mentioned by Abhyuday, has been focusing on capturing the high quality product segment in domestic as well as in the export market. Export for the quarter increased from 23% from 20% in Q1 FY22. Post-COVID recovery we started after the second quarter of the previous year. However, challenges were still there in the last year, and therefore it won't be prudent to compare Q2 FY22 performance with that on a year-on-year basis. On a quarter-on-quarter basis, the pro forma combined revenue and EBITDA both grew by 26% to rupees 7,810 crore and rupees 1,216 crore respectively. On a TTM basis, the pro forma standalone combined revenue grew by 37% over FY21 to rupees 26,259 crore. EBITDA rose by 60% to rupees 3,863 crores, while PBT grew by 137% to rupees 2,834 crores. On the half-yearly basis, the pro forma combined revenue, EBITDA and PBT stand at rupees 14,015 crores, rupees 2,182 crores and rupees 1,752 crores respectively for H1 FY22. I am also pleased to share that share with you that all the operating subsidiaries have also shown positive trend with 2x improvement in EBITDA at rupees 103 crore in the quarter over the previous quarter. Upward trend in the raw material prices resulted into positive inventory valuation due to time lag between our sales and sourcing. The average LME prices of nickel and ferrochrome in Q2 FY22 climbed up by 10% and 21% respectively over Q1 FY22. Our focus on consolidating balance sheet strength continues. as on 30th September 2021, our pro forma combined entity net debt stands at 2,930 crore, down by 38% as against March 21 levels. As we said, we continue to focus on our leverage ratios. The pro forma debt equity and debt EBITDA ratio stands at around 0.4 and 0.8x respectively. With the strategic debt reduction and fall in our borrowing interest cost and borrowing rates, the combined interest cost also fell by more than 50% in Q2 and FY22 to rupees 73 crore and rupees 159 crore respectively. In fact, interest costs stand now 1.25% of our revenue as against about 5% earlier. Focus on prudent capital allocation will continue going ahead. As Abhiday mentioned about our rating upgrade from CRISIL, I am happy that our consistent focus on prudent financial management complementing robust operational performance has been paying off. The recent commissioning of phase 1 of the precision strip will further strengthen our presence in the segment like auto, process industry and oil and petrochemicals, and will be augmenting supplies to aerospace and electric vehicles in the future also. Thus, the ongoing expansion will not only bring about the volume growth, but also it will improve the product mix for the combined entity. This coupled with our cost and supply chain optimization and efficiencies from scale of operation will help us to cater the strong stainless steel demand across various segments and even explore new opportunities. On this note, I would like the moderator to open the floor for the Q&A session.
Thank you very much, sir. Ladies and gentlemen, we will now begin the question and answer session. Anyone who wishes to ask a question may press star and 1 on their touchtone telephone. If you wish to remove yourself from the question queue, you may press star and 2. Participants are requested to use handset while asking questions. Ladies and gentlemen, we will wait for a moment while the question queue assembles. To ask a question, please press star and 1. First question is from the line of Amit Dixit from Edelweiss. Please go ahead.
Yeah, hi. Thank you and congratulations for a good set of numbers. I had just a couple of questions. The first one is my usual question on margins. So we have seen EBITDA per ton sustaining at 20,000 plus for last 3 quarters, and the outlook on stainless steel as far as the global prices are concerned looks quite optimistic with ferrochrome and nickel both supporting it. So would you like to revise your guidance upwards again from 18 to 20,000?
Yeah, so guidance side, Amit, you're right. I think now since half year results are out and we are almost on the 7th month of the fiscal year, given the past trend and given the visibility of next 2 to 3 months, at least clear visibility of next 2 months, we are revising our guidance for FY22 from earlier guidance to 24 to 25,000 on full year basis.
Okay, so it's 24 to 25,000 on full year basis.
Right.
Okay, great. The second question is on essentially the capex program. So these expansion capex essentially. So while you have outlined the various facets and all, can you just give us an idea where we are, on capex and whether it is on schedule or not, particularly in light of COVID-related disruption that we have been seeing in supply chain and equipment supply?
Sure.
Yeah, Mr. Sood, I think would be best placed to answer this question a little bit. I think SPD we already mentioned that has been commissioned, our PS project. For our Jajpur expansion, I think Mr. Sood would be best placed to answer.
Yeah, just to answer the question, there is an update. All brownfield expansion projects announced in Q1 FY22 are on track, and expected spend is also on the track. See, SPD projects, we have already given this update that we have already commissioned, and we expect to ramp up the complete facility in another 3 quarters. That has already been given. And augmenting and doubling the stainless steel melt capacity from 1.1 million ton to 2.1 million ton at Jajpur. That is well on time. Augmentation of downstream facilities and backward integration is well within the expected timelines and progressing well. So in nutshell, if I have to answer your question, yes, we are actually adhering to the timelines. There is no impact of the COVID. So far, we are not expecting any further delay, any delay, any sort.
Great, sir. Thanks a lot for your answer and all the best.
Thank you, Amit.
Thank you. Next question is from the line of Vishal Chandak from DAM Capital. Please go ahead.
Thank you and congratulations on a very good set of numbers, sir. So my first question is with respect to your debt levels. You mentioned the combined pro forma net debt is now 2,930 crores. Given that your capex has now started and that would largely be funded through internal accruals, maybe partly through debt, how should we look at this debt number going forward in FY23 and FY24? You look at going down from here onwards or maybe stabilizing at current levels?
The capex now, the cash outflow will more increase in H2 of this year, because as we said, the H1 was a low capex outflow. It was largely on LCs, and most of these LCs are now getting started due on H2 primarily. So considering those, I think we'll be balancing between our repayment and the capex outflow, and some of the cash which will be a more reduction in some of the initial reduction in the short-term debt, especially on so that we have some liquidity in hand with us.
For FY22, can we assume that we would probably be looking at a similar number for when we exit FY22?
Our current debt level at combined entity is close to 2,930 crores, and maybe we may have some depending on how we progress this on EBITDA. I think number would be slightly less or maybe around this number.
Okay. So my second question was with respect to the capex. If you could just reiterate, how do we plan to spend over the next 3 years on the capital expenditure front?
Sorry,
CapEx spend over the next 3 years.
The next 3 years capex, if you could highlight, especially with respect to the brownfield expansion from 1.1 to 2.1, how much of it has been already spent and how much of it would happen in H2 and the next 2 years?
Okay. So, Vishal, as we mentioned, is that this year, out of this 2,100 crore of Jajpur, Hisar is 450 was separate. Out of this 2,100 overall, whatever capex we said this year outflow would be close to 1,100 crore, and similar outflow will be there in FY23. So I think those means some plus or minus some a few percentage here and there. I think more or less this would be the outflow, as Mr. Sood mentioned, because all our capex outflows are on track and we have mobilized the sites and everything, even the equipment ordering. So it's completely on track. So 1,100 crore will be the outflow this year, and next year also similar outflow.
Sure. Thank you very much, sir. I have more questions. I'll join in the queue. Thank you.
Thank you.
Thank you very much. Next question is on the line of Rajesh Mazumdar from Batliwala and Karani Securities. Please go ahead.
Hello, sir. Good afternoon, and once again, congratulations. So I just had a couple of questions. One is on the overall stainless steel demand. What is the growth rate, if you have the figures, for the industry over the last 5 years, a CAGR growth rate, and what has it been in the recent past?
So I think it's been quite consistent actually. If you see the growth rate for India per se, it has always been close to 7.5%. And stainless steel is actually the fastest growing commodity in the metal space, domestically as well internationally. So we say carbon steel grows around maybe 4%, 3.5%, 4%. Stainless steel is closer to 6.5%, 7%.
So roughly 1.5x of the carbon steel, is that a correct assumption to make, or it could be slightly higher than that also?
Yes, correct.
Okay. And in the recent past, especially in the 400 series, what is the kind of growth rate you see over the last 2 years or so, or 3 years maybe, since there was COVID also in between?
Sorry, 400 series, you had a question on 400 series?
Yeah, I'm saying for the last 3 years, since we are emphasizing on the 400 series, what is the kind of growth rate you have seen in the market in the 400 series over the last 3 years?
So specifically how much 400 series has grown, we can get back on that. But yes, our sales, if I talk about personally JSL side, 400 series over the last 3 years has been growing by almost 5% every year. So we were close to, out of a total portfolio was maybe 12% 3 years back. Now we're close to 23 to 24%. And as a strategic area, every year we do want to increase our sales in 400 series.
See, most of the applications, especially in railways and autos, are actually 400 series oriented. So as more and more users are increasing in these segments, we are seeing a traction. So now idea is basically we are now close to 25-30% in our mix. But having said it, obviously some of the quarter we may see a more of 300 series where we find a better opportunity. So it's a more segment oriented rather than, I think the way market is becoming is more high-end product in segment oriented. Accordingly, the customization and kind of material we also, so it's getting into solution providing mode. So we also then work now closely with the client that what suits them best in terms of the various applications.
Right. And in terms of pricing, is the 400 series more rigid in terms of the number of changes you do per month or per week compared to the other series? Is it more stable, the pricing?
So if I talk about over a 5-year period, yes, definitely it is more stable. But last 2 years, because there has been so much volatility in all raw materials, lot of volatility in ferroalloys, ferrochrome, silicomanganese, ferromanganese. So now I can't say that is the case. But if you look at like a 5-year period, then yes, 400 series generally has been a little more stable grade.
Right. So the prices are fixed what? Every month or less than that now on 400 series?
No. There is no price that is fixed. It totally depends on the segment. It totally depends on the customer. So like for example, railway is on quarterly or 6 monthly pricing. Same with auto. But then we have a lot of customers on spot pricing as well.
Okay, got it. And what about the overbridges and footbridges and those things? Those are also quarterly basis?
We're already added export surcharge as well. So all our export orders have a variable freight clause and an alloy surcharge clause as well now.
So this is one big difference from our international pricing. So typically we are now started testing this mechanism of base price plus surcharge based price based on the underlying commodity in the international market, which help us in obviously which benefits which is a win-win situation for us as well as customer, because if the prices goes down they will benefit, if the price goes up we will be protected with our margin. So typically this is just starting of the journey, and this helps us also to book a long-term export order because there is a long serving time in the export order. So this overall builds a more healthy order book for us.
And my last question is, could you give us some color on the exports from JSL, because we are aware of the exports from JSHL. What are the exact products and which are the countries exporting to from JSL and Jajpur?
So JSL is actually, we export more from JSL Jajpur than we do from Hisar, and our exports are mainly to the same countries only, and the highest end market. So Germany, Italy, in Europe, US we are catering to from Jajpur, Russian markets we are catering to, and now we've also entered the South American market as well.
And the product?
Product is a mix. Again, there is not a specific product. It totally depends on the customer's ask, and we have a very wide range. So there is no particular product. Overall, it ends up being 300 and 400 series is maximum, and a little bit of 200 series.
Okay, thank you so much.
Thank you.
Thank you. Next question is from the line of Chetan Shah from Abacus AMC. Please go ahead.
Yeah, hi. Sir, just one quick question. Can you give us your view on how is the underlying alloy prices you see short term and long term? I know it's very difficult to take a call on, but based on your interaction and experience, how do you see those prices are moving? That'll be very
No,
helpful.
I think it looks to be remaining quite robust, and it will continue to increase the way the world situation is looking, with China power supply issues, shipping issues around the world. Demand is picking up everywhere. So I think for the next few months, it will definitely remain robust, and it will remain at these levels or higher.
Okay. Sir, can you give us some flavor on how our subsidiaries perform, especially the lifestyle and other two, and how you see that faring for the next foreseeable
Subsidiaries
future?
have all done very well this quarter. They have doubled, in fact, over last quarter, Q1. All have doubled. Lifestyle performance has also picked up. We're getting good orders again from railway division, from our OEM business. We've added 3 new OEMs. We've added Tata, we've added Havells, we've added Kent already into our portfolio. So lifestyle has picked up. Railway has picked up again this year, which was a complete washout last year because of COVID. Railway orders have picked up. So lifestyle order book is very healthy. Margins are also better. Steelway has done very well. Steelway also has practically, I think, almost doubled from Q1 also for Steelway as well. So we're getting a good order book from pipe and tubes in Steelway. The only thing that is lagging behind is the auto industry right now. So for JSL as well, and for our service center business, auto industry is the only laggard, but then we have enough opportunity in other segments. So we've also started supplying from JSSL to the pharma segment, medical equipment, which is also doing very well.
Sir, when you talk about new customers in our lifestyle business, so normally these customers, when we take in, are they for like 2, 3, 4 year time horizon? How's the contract work? If you can give us some flavor on that, please.
See, again, it is depending on the segment. It is depending on the customer as well. So there is no clear-cut answer. Like I'm saying in railways, because the nature of the business is that we need to sign long-term contracts. So we do that. Auto also, they like to have long-term contracts because they want their, material or quantity assurance, supply assurance to be there. So certain departments, certain segments we do. Otherwise, it's purely more on spot basis.
Thank you, sir. Wish you all the best and happy Diwali in advance, sir.
Thank you.
To everybody in the team.
Thank you very much. Next question is from the line of Ritesh Shah from Investec. Please go ahead.
Hi, sir. Congratulations for a good set of numbers. Sir, I have a couple of questions. Sir, I'll just continue the prior question. You indicated like for rail and auto, you have long-term contracts. And you also use a word, we have started with export surcharge and alloy surcharge clause. Sir, is it possible to put some numbers and specifically explain the alloy surcharge clause that you spoke about? What I'm trying to understand over here is what percentage of our volumes have a inbuilt pass-through business, and if there is a lag element, how should one understand that?
See, Ritesh, I think if I understand your question, you are saying what percentage of export order we are booking under alloy surcharge, or about the pricing mechanism which we are doing in alloy surcharge?
I'm looking at both, sir. Surcharge clause, you indicated that we have started recently, right? So alloy surcharge clause.
So I think, okay, got it. Let me answer. I think on export side, we are now trying to maximize our orders and on the export side, because obviously not all the markets we can do, some of the segments, but I think idea is that to actually do more than 60% of export orders under this route. Now, pricing mechanism, I think it's quite sensitive at this stage, and it's a bit early stages at the commercial sensitiveness. It's a new thing which outside European, any players have actually started, because typically with that. So it's still more at this stage, we do not like to share much of the details. But idea is that basically, as I said, we have a win-win situation of both of us, customers as well as us, and we can book the long-term order and long-term visibility on the order book. So depending on the underlying commodity prices, it will get adjusted in the future. That's a broad concept, but obviously specific formula it's a more matter of too detailing, and as I said, it's quite commercial sensitive with our customers and also at this stage.
So Mantriji, basically, so what percentage of our revenues will have a pass-through wherein we do not have to worry about if something moves up on the raw material side, it is actually taken care of?
Okay, so if you see typically, obviously this is a more mechanism, but otherwise more or less we follow the similar situation in domestic market where we keep revising prices and when we revise our price and being the leading player, when we revise prices, we consider everything which is underlying raw material prices, international prices, foreign exchange and landed prices, everything. So it may not be look like a completely formula based to the customer, but more or less this is how the prices in the domestic market are evolved. And more than I think 70% of our sales is actually through on a spot pass-through basis.
That's useful. Sir, secondly, I wanted to touch upon, I think we have several products in the basket. I think magnesium is also one of the variables that will be a raw mat for us. Are we good on the inventories over here, or is there any sort of disruption that one could look at? How would we place on this particular aspect?
I think Mr. Sood, if you can take this question up.
I could not get the question right. If you could repeat.
On raw material like certain ferroalloys, what is our position right now? Are we secured or are we facing any shortages?
It's specifically referring to magnesium over here because a lot of global players have been facing problems on the supplies.
Okay. Mr. Ritesh, just to clarify that magnesium is used as an alloying element in non-ferrous metals, not in stainless steel. Magnesium is produced generally in China and it's becoming a major bottleneck for auto industry and other industries, not for stainless steel. Okay, for us, the ferroalloys which we use or the elements or metal which we use are manganese, chromium, nickel, and all those things. And we are well secured in these elements and metals.
And the sourcing for this is locally, including manganese?
Yes, manganese is abundantly found in India and it is sourced locally. 100% it is local sourcing.
That's perfect.
Part of our strategy is to go maximum domestic sourcing.
That's useful, sir. And sir, last question for Abhyuday. So what are we doing as an industry? Looks like it's falling to deaf ears to the government when it comes to imports. How should one wake them up, or what is the industry doing to actually make sure that there are certain trade measures in place to protect the local industry?
So, no, there are continuous efforts are being made. We are in constant dialogue with Commerce Ministry. Steel Ministry is continuously supporting us. They do feel our plight, and we're in constant dialogue with Commerce and Finance Ministry. We have been engaging with Niti Aayog also now because they are the face for the government to promote business, to support businesses. So we have engaged with Niti Aayog, who is also supporting us. So, it is definitely a unique situation because of all the news that came with the steel industry and all the prices that have gone up. So stainless steel along with that also got mixed. So there is continuous effort by Stainless Steel Development Association. We've engaged. All other associations are also feeling the pinch now. So it's a continuous joint effort that we are approaching the government. They are realizing, they are gathering data up. So we are very hopeful that the suspension that they did till January 31st does not get further extended. Otherwise, if they did not feel, then they could have clearly cut it and, thrown it out. But they have suspended it, which means that there is definitely merit in the case. And even though the situation is kind of unique right now, as things start stabilizing, I'm sure this duty will come back.
And sir, any update on the other DGTR cases which are going on against the trade bloc China, Indonesia?
No, not as of now. I think there is constant dialogue, but no update that has come from the ministry till now to us.
Sure, sir. And thank you so much for the answers and wish you good luck.
Thank you.
Thank you. Next question is from Vikash Singh from Phillip Capital. Please go ahead.
Good afternoon, sir.
Good afternoon.
Congratulations on very good set of numbers. Sir, I just want to understand regarding our new capex of 1 million ton. So once it comes in, how quickly we think that we would be able to ramp it, since we would have a little bit of learning curve from the past expansion?
Good. I think Mr. Sood.
Okay.
Yeah. Now please ask your second question.
And the second part is whether, like some of the foreign players, is it possible that by the time we commission this capacity, certain portion of this capacity can be tied up in long-term contracts?
Okay, Mr. Sood, you can take up the first part, then I can answer the second one.
Yeah. Okay, Mr. Singh, the ramp-up time, as you pointed out rightly, that since we are already in this business, the ramp-up time should be lesser. Yes. In a normal circumstances, for a new plant, the ramp-up time is almost 6 to 8 quarters. In our case, we are pretty much sure that this would be cut down by at least half, and we would be at 100% within 3 to 4 quarters.
Understood, sir.
And in terms of your question for long term, see, it's again a very dynamic situation. We definitely have certain segments where we have long-term contracts, which will continue. Those industries are also increasing. So our volumes in those long-term contracts will also increase. Auto industry, definitely once the semiconductor issue is over, there will be huge growth coming in there. Similarly in railway segment as well. Then we have MOUs signed with major customers. Our trade segment, we have MOU signed with pipe and tube players, we have MOU signed. And with the stainless steel industry growing at 6 to 7%, all these volumes will be re-revised with them. So definitely a portion of the expansion will be catering to long-term contracts.
So basically, where I'm coming from, basically because even if we're able to ramp it up within an year to the full potential, the demand might not be going in the similar fashion. And
no demand, we're already behind. I needed the capacity ready this year. We're already behind. That is why if you see imports are coming in to the tune of 40 to 45%. So if you're talking about demand, domestic and global, there is enough demand in the market. We are a little behind actually because whatever reasons there are. So there is enough demand and we are actually behind our expansion.
Understood. And sir, in JSHL, so we are increasing our value addition by 450, so basically by 100 KT. So what kind of incremental margins this project can give in?
So typically, so if we talk about the current situation, that without incremental, because it's in the total volume of JSHL, it contributes 6% in the quantity wise and around 11% in the value wise. So if I say the capacity which we are ramping up and we are having the with the capex of 450 crores in the SPD value added products, if I consider that on the same basis as the today's scenario, so there will be incremental around 4 to 5% in the volume as well as the same similar fashion will be in terms of the value wise contribution to the EBITDA line.
Understood. And just one last question. Your EBITDA per ton guidance is still a little bit less than what we have done in the first half. So second half, is it since the prices are still on an increasing trend? So what kind of cost inflation we are expecting because upon which we are giving a lower guidance than first half?
So basically, if you see the first half, if I remove the almost 77 crore of forex gain, which is now part of the EBITDA, the average EBITDA per ton was close to 25,500 per ton. Now the guidance which we are giving for full year basis 24 to 25,000 because we still don't have a full visibility of quarter 4 specifically and the last quarter of this last month of this quarter. So I think that we are not very way off from our guidance of I think 24 to 25,000, which and guidance means which we should surely be achieving in as per our philosophy.
Understood. Thank you for answering my question and all the best for future.
Thank you.
Thank you. Next question is from Nishit from Equitas. Please go ahead.
Good afternoon, sir, and congratulations on good set of numbers.
Thank you.
Yes. Sir, I wanted to understand, are we facing any raw material availability issues?
No, not as of now, because I must appreciate our purchase department. They have done a very good job. Like for thermal coal, for example, we've already got stock for the next 2-3 months lined up. So from any major raw material side, we're not finding any disruption. Mr. Sood can add on if to something.
Yeah, just to add on and giving comfort, see the kind of sourcing strategy we have made, it is more agile, and knowing the supply chain and logistics disruption, another steps have been taken to ensure availability of key raw materials, consumables and refractory items. Effective inventory management and negotiation strategy has also been put in place to secure the essential raw materials.
Okay. Sir, what percentage do we stainless steel scrap do we get from the domestic market?
I did not get your question. Are you asking what kind of raw materials, what percentage of raw material we are getting from India?
Yeah. Yes. What percentage?
Yes, percentage.
Okay. So, Nishitji, we are getting almost 65% of our raw materials from India, from domestic sources, and almost 30 to 35% from import sources. And the first is continuously localize the raw materials.
Okay.
So, just to add, I think this is a big change, and as Abhiday was mentioning, and what Mr. Sood narrated is that our focus is shifting on the domestic supplier, and even for the foreign supplier, we are asking them to open yards here so that our volatility on the underlying commodity and forex price is reduced. So earlier, if you see, almost 70% raw material was actually imported for us. Now today, as Mr. Sood mentioned, it's actually 65% is domestic. So it's a big shift. What we have been talking in the last calls about focusing on our sourcing strategy. So there is one major change which I think which are also giving us good results on our P&L.
Okay, that's great. And sir, in terms of coal availability, we are not facing any issues, right?
No, we are quite secured as of now.
Okay. So now coming to our working capital, it has been higher this quarter. So going forward, do you see this trend continuing?
See, working capital, because of two reasons. One is that underlying raw material prices have increased substantially. So there's a big increase in the value of working capital, and the funds have therefore the requirement on the working capital side. The volumes also, as you can see, has increased. So both of them are actually resulting in higher working capital for us.
Okay. Sir, and coming to my last question, so do we see our tax rate going to 25% this year?
So if I talk about the two separate companies from JSL and JSHL, so JSHL is right on the lower tax rate. So because JSL don't have any losses carry forward, and that's what we have reported on the lower tax rate. And if I talked about the JSL, so since they have the carry forward losses, so that's the reason they have paid the tax rate under the VAT for the individual company perspective. But once we will merge it, so we will evaluate the position from the total group perspective, and of course it will be on the lower side as a group perspective.
Okay. Thank you so much, sir.
Thank you.
Thank you. Next question is from the line of Navneet Bhaiya, an individual investor. Please go ahead.
Hi Anurag and hi Abhyuday. Congrats for a great set of numbers. My questions were one, you mentioned imports were at 40%. I'm presuming you would be maintaining your market share at 50-55% of the domestic market. So then,
that is what our pitch to the government and as an industry is. That the people who are getting squeezed are the smaller manufacturers. So the government is has to take care of the smaller guys as well, which is what we are trying to pitch to them, that duties are required.
So as of now, apart from the Jindal 2 plants and imports, remaining manufacturing in India would be low single digit contribution. Is my understanding right?
Absolutely.
Yes, currently which are operating. Obviously, as Vijay was mentioning, actually because of the government policy, lot of facilities, MSMEs are actually not getting encouraged for their operating facilities.
Understood. Okay. Second question was, is your export realization similar to your domestic realization, or is it higher, is it lower?
So again, on average, domestic has always been the best performing market for us, but the kind of unique situation is there in the world. Right now, export market is at the same level or sometimes even higher, depending on which market we are looking at. So it's, you can say, comparable or little higher at the moment.
Okay, so then
basically, as we mentioned that now, Vijay mentioned in his opening speech that in terms of the product and geographical mix, we are now more agile.
Right.
So idea is to maximize the order
maximize
where we get
maximize, yes.
So eventually it will get an equilibrium. In some quarter you will see another, but as an investor, I think you should see our idea is that if we get a better margin orders in European market, we will not be shying away from diverting domestic. So that's what agility which we have built in our product mix, production planning and supply chain.
Perfectly understood. So imports which are coming in would not hurt you as a company. Of course, it will hurt the industry because there might be more inefficient plants or smaller scale plants. But because export realizations are also good enough, global prices are not lower than Indian prices. So is my understanding correct?
Absolutely. Understanding is absolutely correct.
Okay, perfect. And my last question was, auto industry would contribute what proportion of your overall sales in a normal environment?
In a normal environment, it is close to 9 to 10%.
Now it's 12%, close to 12%.
12%.
And it's increasing, I think.
I mean, it should have increased without this semiconductor shortage, but
Right.
It's about 11 to 12%.
And which right now would be maybe somewhere in the mid-single digits.
8%, 7, 8%.
Okay, so that delta of 3 or 4% would kick in once this semiconductor thing gets sorted out.
I think even higher it should go, but yes, it will definitely go back to 11, 12%, and
Right.
we expect it to go higher also.
Okay, understood perfectly. Thank you so much and all the best for your future plans.
Thank you.
Shall we move to the next question, sir?
Yes.
Thank you.
Yes.
Next question is from the line of Rishabh, an investor. Please go ahead.
Hello. Yeah, thank you for the opportunity. I just want to ask you, post completion of expansion and post merger, what are the kind of EBITDA pattern you're looking at?
Our guidance for this year EBITDA per ton, we just mentioned 24 to 25,000 per ton. So expansion anyway, and merger will not have it's same. For merger will not have differential, considering the same thing over here.
Because you said like there will be some synergies which will happen, so I'm understanding there are no operating synergies in that.
Which we already started building because the merger is already approved by SEBI and Stock Exchange. It's an NCLT process which is there. So those we are already started building up in our operations.
Okay. And one more thing, there is a perception normally in this industry, steel or metals, except for maybe one group, that the minority shareholders' interests are not fully protected. How do you address this? If you can say something here.
If you can be specific in what way shareholders' interests are not protected, then we can answer it better, please.
Obviously, the cash flows normally, there is things like, that's not fully, what to say, accounted, or you can say there are some related party transactions which happen at, say, not, market parameters or, this kind of issues. Normally, which not be so apparent, but, these kind of things normally happen in this industry. So, I'm just trying to understand if you could say something here.
Governance-wise, I can't comment on generalized thing and that in the industries as a specific because also I'm not privy to the knowledge of my knowledge of these type of things. I can say that as a governance we maintain a very high standard and even on our auditors as well as even our internal auditors are also among the Big Four. So technically, it's not the management audit we get it done from our internal audit. They are actually internal auditor which gets presented to statutory auditor. So and both the companies and all companies internal auditors are among the Big Fours, and the auditors are also in Grant Thornton. So at least maybe I think.
And I think just to add a little perspective, if you see in the history of our company or any other Jindal company as well, we've never had any of these corporate governance issues. So as a company, as a family, integrity is at the highest level for us. And if you have attended our calls in the previous past 2 years, we have been very open, we have been very honest, and everything is on the card for us. So shareholders, we are working for our shareholders. We definitely want to take care of them. And yes, if there is anything specific, you can ask us. But in terms of corporate governance, we have the highest sort of care for that.
Is there any dividend policy that you're looking at or anything?
We are working on it. I don't want to jump and commit anything right now. We're definitely working on it, and we would definitely like to take care of our shareholders.
Okay, thank you.
Thank you.
Thank you. Next question is from Tejas Mehta from Omkara Capital. Please go ahead.
Yeah, hi. Hi, thanks for taking my questions. Just on the capital management side, wanted some more clarity. I'm sorry I missed the first 15-20 minutes of the call, so if you have already answered it, it'll be repetition. On the working capital side, we see that there's a huge amount of inventory which has been built into the balance sheet for both the companies. When is the situation likely to be reversed?
Okay, so the working capital increased. I just answered. Actually, let me repeat that. I think because of two reasons. Because the underlying raw material prices have increased by 40 to 50%. So there is a big value increase even in the same tonnages. So that's one reason of the value increase. Second is that our volumes have also increased. So the working capital increase is corresponding to our volumes and the underlying raw material prices. So and suppose the prices goes down, it will come down accordingly.
Yeah, no. So I was just trying to understand. See, usually you'll be using your free operating cash flows to either repay debt or to fund your brownfield expansion that you are doing at this point of time. But with this kind of capital being blocked in the working capital, you'll have to kind of rely on external capital to complete your capex.
We said hardly it will be done, but yeah, working capital is actually correspondence to our operation. So it's not that we have suddenly large of inventory or something stuck up over there. It's not the case. It's not a aged inventory. Unlocking means if the prices goes up, we'll have to obviously source the raw material at higher prices, keep the production lines and inventories, raw material and WIP inventory according to those valuations. So it's completely corresponding to that. Now unlocking will only happen depending on the market if the prices goes down. Volume side, obviously it will continue to increase. So corresponding to that, there would be a higher working capital requirement.
Got it. And do you expect the inventory levels to probably remain at the same levels now in the second half, given that maybe pricing?
It's difficult to answer because it's if the prices remains and continue to go high, probably it may go up actually rather. And if the prices comes down, it will then get immediately unlocked. So it's completely a combination. Otherwise, we are monitoring very closely up, and we don't see any challenge in our debtors days, and it's not increase in number of days as such.
Yeah. Also, then how are you, funding your expansion at this point of time?
At this point, what we said is largely from internal accruals, obviously, but there was an immediate requirement to put up large part of capital into the working capital because of high increased activity and high raw material prices, which we have done. Depending on that, we'll continue. Now our leverage ratio and all these are in a very good situation. We are in a comfortable zone. We'll continue to monitor and see that how we do the going forward, the working capital debt and long-term debt balancing.
Got it. Got it. And just on
Mr. Mehta,
the
sorry to interrupt, but may we please
sure.
request you to return to the queue for your
No
follow-up
problem.
questions, as we
Yeah.
have several participants in the queue. Thank you.
Okay. Yeah. Thanks.
Next question is from Divyanshu Sachdev from White Oak Capital Management. Please go ahead.
Yeah. Hi. Am I audible?
Yes.
Yeah. Thank you for taking my question. So I just had two questions. Number one, given the fact that now the chrome ore would come from your own mines in Sukanda, so how much saving per ton are you factoring into?
So that is still a little early to comment on right now because, we're still on the process of getting environmental clearance and operation is still to start. So maybe next quarter I would like to take this question up.
Okay. And this saving, since it's uncertain, so you have not factored the same saving per ton in your guidance as well, right?
Yes.
Okay. Yeah, sure. Thank you so much.
Thank you. Next question is from the line of Vishal Chandak from DAM Capital. Please go ahead.
Yeah, thanks. So the first question that I had was, what is the kind of inventory gains that are sitting in our EBITDA at this point in time because of increase in raw material and finished good prices? So if you could just quantify that part because it seems to be abnormally high pricing environment in this area.
See, Vishal, this is inventory, I would say not some of the positive or negative side inventory valuations is the better term to use for this. And this is purely due to the pricing and sourcing mechanism on the SS industry. So, and it just becomes an inherent part of our profitability. So typically there is a 40 to 50 days time lag between as we mentioned that most of our orders, 70% are domestic and now we are moving to export alloy surcharges export pricing mechanism. It's immediately get adjusted with the current spot price, underlying raw material prices. While the sourcing obviously for that, so whenever the price is on rise, there would always be continuous momentum in terms of those type of 40 to 55 days lag time difference, price difference of that period. And it's a vice versa also. But now that at least those risk as a risk management, we have narrowed down this time to for just 40 to 50 days, which used to be earlier, say 75, 80 days earlier.
Sure. So my next question was with respect to, in the past we had raised some, issued some preferential allotment was done. So whereby part of the payment was made. When should we expect the balance payout coming through for the preferential allotment?
So one more tranche have already been put up in the last quarter, and the balance are now there is a timeline till March, so it will come within those timelines.
Sure. Yeah. Thank you very much.
Thank you. Next question is from the line of Saket Kapoor from Kapoor and Company. Please go ahead.
Yeah, namaskar sir, and thank you for the opportunity. Sir, firstly, as you told that the sourcing pattern has changed for the scrap part, and now we are sourcing a major portion, 60-65% from domestic only. So there also, sir, is it a deemed import type that your importers are themselves setting up their stockyard here, and then it is being understood as an import from the country, or it is the end user also is domestic only? That was my.
It's a mix of both. There is end user scrap generation also, and correct, you are right, importer, I mean there are suppliers who are setting up yard and importing materials from abroad. It's a mix of both.
Right, sir. Sir, looking into the your volume for H2, taking into account the utilization levels which have been for the first half, it's going to be in the similar lines for H2 as there is no further room for higher numbers?
Volume will definitely be higher because there was little disruption of COVID in this Q1 of this year. So H2 volume will be higher than H1 of this year.
Because 452 was the volume number, if I'm not wrong. So taking into the nameplate capacity, it would be in that vicinity only, or correct me there?
No, little bit higher, similar numbers. I would say Mr. Sood maybe has better numbers, but I would say it'll be around that level, maybe 10 to 15,000 higher.
And so this acquisition or this company known as JSL what should be the rationale for this? That we have mentioned that for the Jajpur expansion, this is being done. If you could dwell more into it, JSL Ferrous.
Actually, it's a little too early to talk about. This is something that we are internally discussing and working out. So just as an early step, we created this company. What are plans for it? Give me till next quarter because we should have worked it out by then. The next call, if you ask me, I'll be able to answer this question.
It is not related to the greenfield expansion. That it is.
No, it is not related to that. It is some other ideas we do have, but it is too early to discuss or nothing has been taken forward. So I would like to first internally complete the discussion, clear our strategy, then openly talk about it.
Okay. Last 2 points are on the ferrochrome price trend. What are the current spot prices, sir? As we have seen in your presentation, the prices for the quarter were an average of above 1,05,000. So I think so some.
Currently, average price I will not be able to comment on, but currently it's around 1,21,22,000.
1,21,000 and 22,000. Okay. And monthly, for the tax part, we found in the cash flow that the advance tax payment for JSL on a consolidated basis is to the tune of 87 crores. So if we take that math, this is the 45% of what the total tax to be paid. So are we calculating this on the MAT basis itself, the MAT tax of 87 crores?
So for the two companies, so when I explained about that, so the JSHL, since we have adopted the lower tax rate, so the tax liability has been discharged as per the statutory requirement accordingly. And as far as the JSL is concerned, since we have, losses carried forward as an independent company, so we have worked out accordingly. And if you see the current tax expenses, the amount has been calculated accordingly under the MAT, and the liability has been discharged accordingly.
So the point I was trying to make is, if we take this 45% of advance tax at 87 crore rupees, then the overall we are projecting or working with a math of 950 crore for the full year, because then only this 45% proportionate works out.
So right now, since both are the two separate listed companies, so when
I'm talking about JSL only, sir.
Yeah, I am coming to JSL only. I'm coming to the JSL only. So if you talked about the JSL, if the PBT level for the 6 months is 974 crore, correct? And if you look at the tax expense line item which has been calculating accordingly, so whatever the losses were there, it has been adjusted and the liability has been created accordingly. And when you are looking at the cash flow, so as per the statutory requirement, there are installments, but this estimation is done on the whole year basis, not on the quarter basis. So all these factors have been considered while discharging the advance tax liability.
So that was my understanding. So 950 is what we have been taking into account. Then it is on the lower side for the full year.
That's what I'm saying. See, when you estimate the liability for not on the quarter basis, that is what the standard requirement is there. But when you look at from the estimation, you consider the whole year as a put together. So while arriving discharging the advance tax liability, and depending upon the cash flow situation and priority, accordingly we discharge the liability.
Right, sir. I'll take it offline. And thank you, sir, and all the best, sir, and happy Diwali to the entire team, sir.
Thank you. Happy Diwali.
Yeah.
Thank you. As there are no further questions, I now hand the conference over to the management for closing comments. Over to you.
Thank you. I would like to thank everyone for attending this call and showing interest in JSL and JSHL.
There are more than 20 parties in the conference.
Completion of merger along with slated capacity expansion and better product mix will help us maximize the value for our stakeholders. I hope we have been able to answer all your questions. Should you need any further clarification or like to know more about the companies, please feel free to contact our investor relations team. Thank you once again for taking the time to join us on this call. Wishing you all a very happy and safe Diwali.
Thank you very much, sir. Ladies and gentlemen, on behalf of ICICI Securities, that concludes today's conference call. Thank you all for joining us, and you may now disconnect your lines.